Forex traders of the UK, let's get straight to the truth. Most people think the edge in Forex comes from finding the perfect entry signal, the best indicator, or some secret trading strategy no one else knows. But here's the reality: the real edge is not in the strategy, it's in risk management. Point 1. Why most UK traders blow their accounts. The truth is harsh, but it needs to be said: most UK retail Forex traders blow their accounts not because they can't find entries, but because they don't respect risk. They get caught in the illusion that trading is about finding the perfect signal or the magic indicator that guarantees profits. But in reality, it's not the entries that destroy them, it's their lack of risk management. Walk into any beginner trading group in the UK and you'll see the same story repeated over and over. A trader starts with a 500 or 1,000 in their account. They've watched a few YouTube videos, maybe joined a Telegram signal group, and they're excited. They believe 1 or 2 big trades will double their account. So what do? They put half their balance, sometimes even the entire account, on a single trade, convinced this is the one that will change their life. At first, it might even work. Maybe GBP USD spikes in their favor because of a bit of positive news. Their account jumps. They feel like a genius. But then comes the inevitable turning point. The Bank of England surprises the market with a dovish comment. Inflation numbers come in worse than expected. The pound drops hard, and within minutes, their entire account is gone. Not because the market was unfair, but because they risked everything on one position. The UK Forex market is one of the most volatile in the world. GBP pairs, especially GBJPY and GBP USD, can move 50 to 100 pips in a flash. Without stop losses, without risk limits, without discipline, those moves wipe out accounts instantly. Beginners don't blow up because they're wrong about the direction. They blow up because they risk too much when they're wrong. Professional traders in the UK understand this. They don't chase one big win. They focus on survival. They know that losing trades are part of the business, but small losses don't matter if your account is protected. What matters is staying alive long enough for probabilities to play out. So when we ask why most UK traders fail, the answer is simple: it's not bad signals, it's not bad indicators, it's bad risk management. Point 20. Risk management. Survival in Forex trading. Survival is everything. Let me say that again: survival is the edge. Because no matter how skilled you are, no matter how sharp your analysis is, if you don't survive the losing streaks, you'll never see the winning streaks. And the only way to survive is through risk management. Most beginners in the UK approach trading like a sprint. They come in with a small account, usually 4,500 or 1,000, and they want to double it within weeks. They risk 20% or more per trade, thinking that one good run will change their financial life. But trading is not a sprint, it's a marathon. And the marathon is only won by those who can last the distance. Think about it: if you risk 20% of your account on one trade and lose, you're already down 1/5 of your capital. 2 bad trades in a row and nearly half your account is gone. Do you realize how much harder it is to recover from that? If you lose 50% of your capital, you don't need a 50% gain to recover, you need 100%. That's why most beginners never climb back once they fall. Now compare this to disciplined risk management. A professional trader risks 2% per trade. That means even if they have a losing streak of 10 trades, a nightmare scenario, they're only down 10–20%. Painful, yes, but survivable. And survival is the key. Because once the market shifts in their favor again, they're still in the game to take advantage of it. The UK market is brutal in this sense. Volatility around Bank of England decisions, GDP reports, or inflation numbers can create unpredictable moves. Even the best setups can fail during such events. But a trader with strong risk management doesn't care. They know every single trade is just one of many in a long series. They don't need to be right every time. They just need to manage risk so they can keep showing up tomorrow. That's what survival means. Risk management isn't glamorous. It doesn't promise fast riches, but it gives you something far more valuable: time. Time to learn. Time to refine your strategy. Time to let probability work in your favor. And in Forex trading, time is your greatest ally. Without survival, you have nothing. With survival, you have everything. Point 3. The UK market is volatile. If you are trading in the UK, especially pairs like GBP USD, EURD GBP, and GBP JPY, you are dealing with some of the most volatile currencies in the world. And this volatility is exactly why risk management is your real edge. The pound is highly sensitive to economic data, Bank of England BOE policy, and global events. One inflation report, one interest rate decision, or even a single unexpected comment from the BOE governor can move GBP pairs 50 to 100 pips within minutes. For traders without risk management, this volatility is a death sentence. Picture this: a beginner sees a bullish setup on GBP USD and goes all in, risking half their account. But right after they enter, UK inflation numbers come in lower than expected. The market drops instantly. Within seconds, their trade is deep in the red, and their account balance is cut in half. They didn't blow up because the setup was terrible. They blew up because they weren't prepared for volatility. Professional UK traders understand this. They anticipate volatility instead of fearing it. They always check the economic calendar before entering trades. They know when high-impact events are scheduled, and if they trade during those times, they size their positions conservatively or stay out completely. Risk management allows them to survive the chaos and still be around when the dust settles. Volatility isn't just about news events either. The London session is the most liquid and active Forex session in the world, responsible for around 35% of all daily Forex volume. That means huge moves, whipsaws, and fake-outs are part of the daily routine. Traders who risk too much get destroyed by these normal fluctuations. Traders who manage risk, they ride through it calmly, knowing no single trade defines their career. Here's the hard truth: you cannot control volatility. You cannot control the Bank of England. You cannot control inflation numbers, surprise headlines, or global risk events. But you can control how much you risk on each trade. That's the only control you truly have in this market, and it's the control that saves you. So in the UK Forex market, volatility is not your enemy. Lack of risk management is. Volatility is simply the environment we trade in. If you respect it, manage your risk, and trade with discipline, volatility becomes your opportunity. If you ignore it, volatility becomes your executioner. Point 40. Risk management builds confidence. One of the most overlooked benefits of risk management is not financial. It's psychological. Good risk management doesn't just protect your account, it protects your confidence. And confidence is the difference between a hesitant, fearful trader and a calm, decisive one. Think about what happens when you risk too much. Let's say you put 20% of your account on a single GBP USD trade. The moment you hit buy or sell, fear takes over. You're glued to the screen, watching every tick, panicking with every tiny red candle. If the market moves against you, even slightly, your emotions explode. You either close the trade too early, cutting profits short, or you freeze, unable to act while losses pile up. This constant fear destroys confidence. Instead of trusting your strategy, you second-guess yourself. Instead of executing with clarity, you hesitate. Eventually, you stop believing in your ability to trade at all. That's why so many beginners quit within months. Their poor risk habits kill their confidence long before their account goes to zero. Now let's flip it. A disciplined trader risks only 2% per trade. Before they even enter, they already know. If this trade goes wrong, I lose just 1%, nothing more. That certainty frees them. They can place the trade, walk away, and let the market do its work. No panic, no staring at charts for hours, no emotional roller coaster. With this mindset, confidence grows naturally. The trader doesn't fear losses because losses are small and controlled. They don't feel pressure to chase trades because they know survival is guaranteed. Every trade becomes just one of many in a long series, not a life or death moment. And here's the key: confidence built on risk management is real confidence. It's not the false confidence of a lucky winning streak. It's the calm, steady assurance that comes from discipline. That kind of confidence lasts through losing streaks, volatile news events, and tough markets. In the UK, where volatility is constant, this confidence is priceless. Without it, traders crumble at the first sign of stress. With it, they can execute their plan with clarity, no matter how wild the pound moves. So remember this, risk management is not just about saving money. It's about saving your mind. And a strong, confident mind is the true weapon of a successful trader. Point 50, risk management is discipline in action. Every trader talks about discipline. Everyone says, you need to be disciplined to succeed. But here's the problem. Discipline is an abstract word until it shows up in action. And the clearest, most practical form of discipline in Forex trading is risk management. Discipline is not about motivation. It's not about feeling hyped up after watching a YouTube video or reading a motivational quote. Discipline is about doing the right thing when it's boring, repetitive, and even uncomfortable. And nowhere is this truer than in risk management. Think about it. Discipline in risk management means setting a stop, loss before you enter a trade, and refusing to move it when the market turns against you. Limiting yourself to 1-2% risk, even when you feel tempted to, go bigger this time. Walking away after you've hit your daily loss limit, instead of revenge trading to get it back. Accepting a small loss with dignity, instead of hoping and praying for a miracle reversal. These are not glamorous habits. They don't make flashy social media posts. But they are what separates traders who survive from traders who vanish. Signals won't enforce this discipline for you. A signal might tell you what to trade, but it won't tell you how much to risk. It won't stop you from leveraging. It won't slap your hand when you ignore your stop loss. Only your own discipline can do that. And here's the beauty: once risk management becomes your habit, discipline becomes automatic. You no longer argue with yourself about whether to risk 5% or 10%. The rule is set, and you follow it. You no longer stress about moving stop losses. You simply let the plan play out. In the UK Forex market, with its constant volatility, this discipline is non-negotiable. Every day, the market will tempt you to break your rules. Every day, greed and fear will whisper in your ear. But if you stick to risk management, you silence those voices. So if you want to know what discipline looks like in real life, don't look at flashy wins. Look at the trader who risks small, respects stops, and survives month after month. That's discipline in action. That's risk management. Point 60. Compounding comes from protection. Every trader dreams of turning a small account into a big one. They imagine starting with 1,000 and building it into 10,000, the 50,000, even 6 figures. But here's the truth that most beginners don't want to hear: you can't compound what you've already lost. Compounding only works if you protect your capital, and that protection comes from risk management. Think about the power of compounding. If you grow your account just 3% a month, it might not sound exciting. But over a year, that's more than 40%. Over 5 years, that small steady growth can turn a modest account into something life-changing. That's the magic of compounding: slow, steady growth that snowballs over time. Now compare that with the gambler's approach. A trader risks 20-30% per trade, hoping to double their account in a week. Sometimes, they succeed in the short term. They brag about doubling their money on social media. But eventually, the risk catches up. One bad trade, one unexpected Bank of England announcement, one volatile news event, and it's all gone. You can't compound zero. Professional traders in the UK understand this deeply. Their mindset isn't about chasing jackpots. It's about protecting capital first. They know that as long as the account survives, growth will come. They might risk just 1% per trade, but they repeat that disciplined approach hundreds of times. Over months and years, those small controlled risks compound into consistent profits. Here's another way to think about it: trading is like farming. Signals and gambling are like trying to harvest overnight. You rush, you cut corners, and you destroy the soil. Risk management, on the other hand, is planting seeds carefully, protecting them, watering them, and letting them grow. Compounding is the harvest that comes only because you protected the soil. In the UK Forex market, where volatility can wipe out weeks of gains in minutes, protecting capital is everything. If you risk too much, you won't survive long enough to see compounding work. But if you respect risk, Stay disciplined and keep your account alive. Compounding becomes your secret weapon. So remember this, compounding isn't about hitting big wins. It's about protecting small wins and letting them stack up. Protect your capital, and your capital will protect you. That's how real wealth is built in Forex trading.